introduce our next session, Fintech Developments in Venture Capital. I'm excited to introduce Stephen Lord, the Fintech Practice Lead, CFO, and Chief Learning Officer of Burkland. Welcome, Stephen.
Thank you very much. Really glad to be here. And I can really only echo everything Steve just said. We are on the fractional CFO side. We're often involved in presenting those companies to venture capitalists. And for the entrepreneurs that are looking for VC funding in the audience, please go back and listen to that again before you go visit VCs, because I can really only second everything he said. Really, really good. Some of what he was saying will tie into what I'm going to present as well. So let me go ahead and share my screen. So what we're going to talk about today is venture capital as it's relating to fintech and how fintech is relating to venture capital. There's a lot of nuance there and a lot of back and forth. Both are very big areas, so I won't get into all of the different nuances, but I think it's important that we understand that there's a lot happening there and there's a lot changing there, both on the company side and inside of what we see VCs thinking about, caring about. Steve mentioned a few of them a little earlier, so we'll get to that in a minute. Let me dig right in. So a little bit about Burkland. Burkland Associates is headquartered in the Bay Area. We also have a team here in New York. I'm in New York. It's a fractional CFO, accounting, tax, and HR light service provider. We focus primarily on seed stage through C, B plus C stage, VC-backed firms. So much earlier than seed, and it's 3 kids and a laptop living at their mother's. And much after C, they've typically hired in a CFO full-time, and that's great. We love to be able to shepherd companies from this like seed area all the way through their major funding rounds. We have about 430 clients nationwide, and we focus mostly on SaaS, fintech, consumer, and healthcare startups. It doesn't mean we don't have companies in those other sectors, but those are somewhat of our sweet spots. About $6.5 billion in VC funding of our clients since inception, and we work pretty closely with about 50 VC partners. So there we go. What I wanted to talk about, set the stage a little bit here with 2 main stats. And there are a lot of stats we can pull to kind of underscore what I'm about to say, but these are 2 good ones. About 75% of consumers globally have used a fintech product, either money transfer, payment, something like that. That's from Ernst & Young in 2019. So that's pre-pandemic. It's much higher now. And McKinsey put a thing out in June of last year that talked about 5 years worth of adoption of fintech technology took place in about 8 weeks during the pandemic. The pandemic was this huge forcing function accelerator in fintech adoption for reasons everybody on the call knows, but that has really served to underscore the utilization of technology in a fintech world. Now, what does that really mean? That's where the rubber hits the road. A long time ago, and one of the folks at Andreessen Horowitz, everyone talked about this, and this was a big deal. I think it was 4 or 5 years ago. Andreessen Horowitz associate talked about how everyone was going to be a fintech. Well, from our view, across those 400 and some odd companies, everybody is pretty much a fintech now. You're either using it, your product is using it, your consumers are using it, you're using it. Somehow you are touching a fintech application. And remember, fintech is a very, very, very wide zip code. And it's a very, very broad sector. So it's everything from payments to prop tech to reg tech to all sorts of cool stuff, right? Crypto's in there, you name it. Your competitors are all using it. And we're going to talk about this. Your VCs are using it. Your VCs, the business model they may be using is changing because of fintech. So for entrepreneurs in the audience, super important to understand, even if you are making widgets in a factory, you are probably using fintech, encountering fintech. Your clients are using it, your customers are using it, your competitors are using it. Okay. However, fintech is one of those rare sectors where the regulatory environment is somewhat more unique or a little bit more prevalent than, say, your regular technology sector. So the regulatory environment is lagging the innovation in fintech. And we're seeing this, all over the place. Crypto is obviously the most visible example, but it's in banking, it's in payment flows, it's in licensing, it's in audit and assurance, and so somewhat tangential to our world. There's a lot of regulatory changes that are going to be coming down the road as that world starts adopting to the innovation that's going on. And that creates both a little bit of chaos, but also a lot of opportunity. So I would like everybody on the call, VCs and entrepreneurs alike, to understand that the regulatory changes that are going to be coming in the next, say, 2 to 5 years will be reacting to what's happened in, say, the last 18 months or 2 years. Okay. Now, this loops back to one of the things that Steve was saying. One element that fintech is doing in the startup space is it is creating a greater awareness of and demand for reporting. I think Steve mentioned, use the data. Investors need data. And that loops back to what I'm talking about. We see this in the clients that we work with. Investors, VCs, the folks you're pitching to, the folks that have already invested in you and want to know what's going on. The demand for the data out of your business is growing exponentially. They expect you to have extremely granular data. If you're a SaaS startup, on your cohorts, on all of the metrics, LTV, LTV to CAC, net dollar retention, all of this stuff. And they expect you to have it easily, and they expect you to have it quickly. So the days are gone where you can just kind of do all of this in a giant spreadsheet and hope you can trace everybody through the formulas. They do, especially operating businesses that have a product in market, they expect you to be doing things in a data-driven way and be able to report on what you're doing. Don't assume that the data will fill in, as Steve was saying before. If you're pitching a business that hasn't really gotten going yet, go ahead and look at the kinds of metrics that businesses that are successful in your space are reporting and model those out so that you are showing where you're going to be, right? The old sports analogy, you don't pass the puck where the player is, you pass where it's going to be, okay? This ties into systems and processes. There are now a ton of applications out there to help businesses report this stuff. Stripe, Square, QuickBooks Online, obviously, is the daddy of all fintech things as it relates to our world. All of these apps are there now. SaaS Optics, right? If you're a SaaS business, those sorts of applications will make a very simple job of tracking what's business, and you really need to have that stuff. So don't be shy early on about saying, yes, we're going to go get these tools and we're going to implement them in our business. Don't be shy of making sure your VCs know you're going to spend money on these tools, because that's a very important part of your business. You, as the entrepreneur, want to know what's going on. Okay, you have to think this way. The entrepreneurs that are not kind of at the bleeding edge of this stuff are a little bit deer in headlights when they're asked about some of these metrics and have not thought through how they're going to get the data, what they're going to be reporting. The granularity demand is extremely high. Okay, and this is everywhere. This is not only in your operative business, it's in the cohort analysis, it's in your pricing, it's in scenario planning and modeling, it's in your cap table and your waterfall analyses. All of this stuff comes together now because fintech innovations have allowed the visibility to increase. So therefore, the data demand has increased. The last bullet on here speaks a little bit also to what Steve was talking about. The fintech revolution, so to speak, has created a bunch of different opportunities. It's beyond just good companies coming up with good ideas. There's a record, I think, 152 billion in dry powder in VC firms at the end of 2020. That's according to, I believe it was Preqin. This adds to the pressure for those folks to get deals done. They have investors that are expecting them to deploy their capital. What does that do? That increases the valuations for firms in key areas, good firms that have their act together, that have good decks, good pitches, good products. I loved Steve's advice to bring the product into the client. That is so true. We had a client that was a food startup, as Steve mentioned, and the fella brought in his meatballs and fed them to the guys at the VC firm for lunch, and they had a check by the end of the afternoon. True story. So Don't be afraid of that. Don't be shy of that. If you're not proud to show your product to people or what you want your product to do, then why would they be, right? But what that means is the competition for strong deals, for good companies that are working in key areas, and fintech is one of them, are in that competitive environment that Steve mentioned. And that means the valuations are going up. So don't be shy. Okay. Make sure you use the environment to create what you want. We're seeing this in the average deal value. We're seeing this change what seed used to be. Seed is now what an A used to be, and an A is really more what an A plus or a B minus used to be in terms of funding stage. It's not strange to see a $5 or $8 million seed round nowadays, right? Preqin also put a stat out that deal value is up over 100% since the same period last year in Q1 of 2021. So assume the pandemic is kind of a valley that we're seeing across. The deal values have continued to rise because of this innovation, because of the dry powder in the sector. Now, fintech has done two things, in my view, that are sort of like macro questions for us to ponder going forward. The one's a little boring, but it's really important that if you're an entrepreneur on the call, this will matter to you down the road. Fintech is changing a little bit, or has the potential to change. That's why it's a question. Some of the macro reporting that we do, you guys have all heard of when you pay an invoice net 30, you might get a little discount, right? But why net 30? Why? Because that rule, sort of that convention grew up back when we were, writing on parchment paper with a feather. I mean, it's really a vestige of a much earlier age. Now we can pay essentially instantly if we want. So we're starting to see intriguing questions around how is fintech changing the accounting and the financial reporting inside of a business. This is not there yet, but it is one of the things that we're starting to see become a topic in our world is, well, maybe we should give people a discount if they pay in 3 days, right? Instead of 30. What about putting a premium on the payment speed with which you have to process checks? We all are using Bill.com and Expensify and all of these great tools. They still are intersecting a banking system that likes to sit on float for 3 to 5 days. Think of your payroll. Your payroll comes out probably 3 to 4 days before your people get their money. We expect that window is going to increasingly narrow, and you're going to have more and more ability to use that capital differently. From our world, what does that mean? That increases your working capital and your float and a whole bunch of other really good stuff. Okay. Digital assets play a role on this. If I've sold a token, what is it? Is it revenue, or is it a liability on my balance sheet, right? The gig economy is changing things. If we can use Gusto now to pay people, and they're a contractor in Wyoming working 2 days a week in the office and 2 days a week at home, what are they? Where are they paying taxes? All of these things, and we don't have the answers yet, but I wanted to flare, all of these things are sort of in play now because of fintech innovation in the commercial space. Regulatory frameworks obviously also are a big player in all of this because some of this is driven by regulation. Think of ASC 606, the revenue recognition standard that probably is driving most of the people on the call crazy. That really wouldn't even be at that feasible without technological backstops in how we report. The next macro question really relates to your VC backers and the VC community in general. Fintech is going to do a bunch of things to the way they work. It's going to make their decision cycles flatter, quicker, and much more quantitative. It was quantitative before, don't get me wrong, but it's now going to be even more quantitative, back to what Steve was saying about the data driving an awful lot of this stuff. And what I mean by flatter is that because of fintech, they're able to manage their portfolio much better. They're able to see those trends in the world much easier, much quicker. Quicker also relates to the due diligence process. They're going to be able to evaluate your startup against the other 100 that they've seen this week much faster. The process is much less manual. So as a startup, you want to embrace that. You want to make that job easier for them. We have a saying in Burkland for all the CFOs that work with us: always be due diligence ready. right? You want to be able to send a deck out to anybody literally the day they ask for it. You can do that now because all of these tools exist to provide the data that backs up what your product is doing, the kind of fit you've got, the revenue growth, the margins, whatever it is that you really want to highlight. You can do that now. So don't miss that opportunity to provide them the data that allows them to make those decisions easier. Another thing that's really changing is we're seeing a much greater emphasis on cybersecurity, obviously SOC 2 audits to make sure your tech stack is up to speed. Privacy is a much greater concern relating to both of those. So VCs care a lot about this because that's one of the key areas where things can really blow up, regardless of how good your product is. If you're not paying attention to that world, and you're a tech business, you can really end up on the wrong end of things. And they care a lot more about that than they did probably 2 years ago. Again, there are tools now that let you do that, fintech tools that allow you to take care of these issues ahead of time, or at least be in a place to manage them. Okay. And then the final thing that we think is happening is there's a bit of democratization that's going to happen. Fintech is also allowing that reach, right? That data to expand and there to be a greater influx and outflow of information sharing. That's changing a little bit, and we're beginning to see the green shoots of it. I wouldn't say it's a raging trend yet, but it's getting there, of a wider net or a wider tent in the VC space to backing startups outside of the traditional Bay Area, New York corridors. There's a sense that they can get the touch and the feeling that they need in a startup, if they're maybe not in one of those two locales, because they are also more used to working remotely. They have had to make decisions remotely, and now they can actually get on a plane. Maybe in that one meeting is sufficient to meet with you, and you're in Minnesota or you're in Texas or you're in Chicago. So we think that over time, this fintech revolution is also going to help widen the boundaries a little bit of who is getting backed and where are they. Which we think is great because there's a huge sort of neighborhood that's not in one of those two spaces that does struggle to get visibility amongst the really well-known VCs. And we're seeing the VCs back to that demand for really interesting deals. We're seeing the VCs utilize this technology to uncover really compelling opportunities in places where maybe other folks are not looking. That competition that Steve was mentioning in the prior session is very real. So if they can get to a really intriguing startup that happens to be in Northern Vermont, and they can back that startup at a lower valuation than they would if that same startup was in New York, in Silicon Alley, or in the Bay Area, and there's 15 other VCs bidding to be part of that seed round, they're going to do it. And so they're actively looking for that. So I encourage all of you guys in the call or in the conference that are maybe not in one of those two areas. Don't let that get in your way. There are people looking for you, and just if you have the data and you're able to present it in the right way, I think you'll get some good attention. So I think I'm coming up on time. I always like to make sure there's room for questions in these, particularly around what we do as fractional CFOs. We see people in all manner of preparation stages. Some have their act really together. Some make you kind of want to cringe when they get into a startup's VC's office, and we want to try to get to them ahead of time. So anybody have any, do I have time, Molly, or am I out?
You have 2 minutes, but
I have 2 minutes, not bad.
But I don't see any questions come in.
All right, great. If anybody does have questions, here's our website and here's my email address. I also had knowledge share for Burkland. So if you have any questions just in general about how should I think about raising money or dealing with my finance stack, please don't be shy. Let me know. And thanks for having me. I really appreciate it.
Thank you, Stephen, for your thoughtful insights.